Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, I would like to talk about the state of ESG investing, or the sorry state of ESG investing, that is. ESG investing stands for environmental, social, and governance investing. And a lot of people out there are interested in aligning their investment dollars with their personal values and ideologies. That concept has really taken off in the last 10 or 15 years and is gaining a lot of momentum. Unsurprisingly, a lot of investment managers have created funds to do just that. The problem is that the funds are not always doing exactly what the managers say that they are doing, and corporations are claiming to operate in ways that align with the values of these funds and then not really doing that either. So ESG investing has come a long way. It's a very interesting segment of the markets. It's something that a lot of people have interest in and will continue to get better, but it's not in a terribly good place today. And I wanted to dive into that because we do get a lot of questions about that. It is a great idea and a great concept, but currently it has quite a ways to go before it's a great product for consumers. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Today on the podcast, I would like to talk in a little bit of depth about the sorry state of ESG investing. ESG is an acronym. You may have come across this in the past. It's been in the news quite a bit, especially in the last week and over the last couple of years. I'll get to why. But it's an acronym that stands for environmental, social, and governance. And the whole idea is that there is a lot of interest these days in deploying investment resources in a way that aligns with personal values. And ESG investing has long been hailed as a way to do that. And it is. It really, truly is. But it's also kind of gone down a bad path over the last couple of years. And, you know, for people out there that do feel strongly about certain political issues on, one side of the issue or the other, there are some vehicles you can use to invest your money in a way that aligns with those values. But it's kind of a treacherous landscape right now. And there's really three reasons why. So I'll get to why it's been in the news recently, but I want to cover three things that I think everybody ought to be aware of as it relates to ESG investing, because we're going through this, I would call it a growing pain in this side of the industry. And there are definitely a few things that need to get sorted out in order to have an industry and an ESG product offering that is good for people that want it and transparent at a reasonable price, and all the things that as consumers we would want to have in any one of our investment vehicles. So the three big issues going on right now. Number one is greenwashing. I happen to be wearing a green sweatshirt today, just coincidentally, has nothing to do with our episode. The second is nepotism in the investing world, and the third issue is performance. Obviously, if you're considering taking your investment savings, your retirement savings or otherwise, and investing it in a certain way that promotes companies that behave in a way that's aligned with your own ideology, that makes a lot of people feel good, but we probably want to know what the potential performance impact of that is as well. So those are the three big things going on. And I want to explain each of them in detail and give a couple examples after having refreshed my memory and really reading up on what's going on. The reason this all came to light is that Florida decided to pull a whole bunch of money from one of their fund managers, BlackRock, because of ideological differences. And you can probably guess where this came from. It came from their Treasury's office, the office that's responsible for the Florida Pension Fund. They have a whole lot of money that's invested on behalf of pensioners, state and public employees in Florida, and they have an investment manager that handles some of that for them. Well, they didn't like how BlackRock was behaving as an organization, so they're pulling their investment mandate from BlackRock, which means that they're taking their money and taking their business elsewhere, basically. So this is a pretty big headline because it's, I think, $2 or $3 billion, I want to say, which is kind of a drop in the bucket for BlackRock's business. That BlackRock is the biggest investment manager in the world. They have more than $5 trillion, I think, under management, which is just a huge, massive number. But that's why this came to light today. So to launch into this, let's jump into what greenwashing is. Greenwashing is a problem in the ESG community, and the primary reason is this concept has gotten a lot of attention over the last decade or so. There are a lot of people that we work with in our financial planning firm, a lot of people that we speak with otherwise are have a growing interest in this kind of investing. And it doesn't matter what side of the political spectrum you're on. A lot of people are interested in aligning their investment portfolios with their own personal ideology, whatever that means to you. And because of that, more and more investors are asking for ESG focused options, whether that be through a mutual fund or an exchange traded fund, or maybe some other kind of private or alternative investment or managed account or something along those lines. And so, from an investment manager's perspective, if you're the manager of a bunch of mutual funds and you're trying to grow your business and market your services and get more interest in people investing in your fund, well, if you have all these questions, people want this thing, then you're probably likely to establish an ESG focused fund to meet that demand and continue growing your business. And because of all the interest, there's this concept of greenwashing where an investment manager will, or a corporation, this can be either, will claim to operate their investment or their fund or their company in an ESG focused manner, when in reality, it's just lip service and they're not actually doing what they say they are. They're just promoting the ESG benefits of the investment or the company or whatever it is for strictly marketing purposes without going through any of the underlying trouble. And so you have this concept of investors want to align their resources in a certain way. They purchase an investment because it's been marketed as an investment that will check those boxes um, and do what the investors want, and then it turns out that none of those things are actually true, right? So it's close to fraudulent. The SEC is starting to look at this quite a bit more, but this happens at both the fund level and the company level. So a couple interesting examples here. At the fund level, and when I say fund, I mean a mutual fund or an exchange traded fund, the common types of investment vehicles that ordinary people like you or me would use to access a portfolio like this. The Economist took a look at this in detail, I think it was last year. I have a couple notes here. I'll refresh my memory on the details. So the magazine took an in-depth look at the 20 biggest ESG funds, and biggest by size of portfolio. So the 20 ESG funds with the most assets in them, they found that every single one. So, well, let me back up. If you think that an ESG focused, if we let's set our expectations for what we think would be inside an ESG focused fund, right? And again, there are funds that align with more left-leaning ideology. There are funds that align with a more right-leaning ideology. Typically, if you look up any ESG fund, you're thinking of like a greener, sustainable, environmentally friendly fund that also leans left politically. That's typically what it means. And so the economists looked at the 20 biggest funds by assets, and they found that every single one of the 20 had holdings in fossil fuels, and many of them also had substantial holdings in oil producers, coal mining companies, gambling, alcohol, and tobacco. So, just on the face of it, you would think that this whole idea is a total scam. If you're wanting an investment vehicle that's sustainable, you're probably not. And this is different for everybody. Maybe your opinion is that we do need more coal mining, or we do need to produce more oil, or whatever, and you're still really interested in sustainability. I'm not going to get into the science or the politics of it today, but the holdings, the takeaway is that the holdings of every single one of the 20 biggest ESG funds were far different than what the editors expected to find in them. Now, this does lead us to an important distinction. There are a couple ways to draw up an ESG fund. Let's say that you legitimately do want to uh, build a portfolio that aligns with that specific ideology. There are two primary ways that that's done. One of them is by weight, another is by elimination. And so if we're doing this by weight, what you might do is come up with some factors that you think are important with regard to ESG values or ideology, or whatever you want to call it. And it might be carbon emissions as a corporation might be one. Another one might be I don't know how much coal is produced. Those are a couple examples. And then you can go through an investable universe of securities. Say you look at the biggest 3,000 corporations in the US, and then you can score every single one of those corporations based on their carbon emissions and all these other factors. And after you weight the portfolio according to those factors, then bang, there's your list, there's your portfolio, that's what you invest in. So the fact that the 20 biggest ESG funds still have holdings of oil producers, coal miners, gambling companies, so on and so forth, that could be a legitimate thing. I don't mean to throw this whole thing under the bus, because if you build it based on weight, you can still overweight the companies with practices you think are more sustainable and underweight those that you think are not. So that's one method, is by weighting a universe of securities. The second method is by elimination, where you simply say, here's my values, here's the stuff that I like, here's the stuff that I don't like. I want to take the biggest 3,000 corporations in the country, and then I want to omit anything that operates in gambling, alcohol, firearms, coal mining, whatever. So what it seems to me that the largest ESG funds are simply building their universe of securities, their portfolio based on weight, and probably not by elimination. I'm sure that there are some out there that claim to eliminate these holdings specifically, and then flat don't do that. So that's another misnomer. But the whole point here is that greenwashing is a big deal. As a consumer, if you buy an ESG fund, you are likely thinking that at minimum, those types of companies are underweight compared to an ordinary index or an ordinary portfolio and group of securities. And maybe that's the case on the 20 biggest funds, but something tells me that that's not entirely accurate. Here's another one. So the economists looked at it. There's a group. This is last year, 2021. A group from Columbia University in New York and the London School of Economics took a look at a whole bunch of ESG focused and non ESG focused portfolios. I think the total number, looking at my notes here, 147 ESG focused portfolios and 2,000, a few more than 2,400 non ESG portfolios. Of the companies in both of those categories, they omitted everything that was domiciled outside the US and included only US corporations. What they found was that the companies inside the ESG portfolios actually had a worse compliance record for labor relations and environmental rules than the companies in the non ESG focused portfolio. So that's a total shock, right? Yes, the 20 biggest ESG funds might contain some fossil fuels, coal miners, here and there. We don't know, and yes, we could dig into the exact specifics of that. I don't quite have the time to do that at this moment. But when you look at the universe of ESG versus non ESG funds, and the U.S. companies that are inside those funds, the ESG focused companies are the ones that are supposed to be ESG focused actually had a worse record. Again, and that's environmental rules and labor relations. And on top of that, a lot of the companies are going to change horses periodically. So an ESG manager might add a company from a non-ESG fund because the corporation is changing practices or has a new CEO and is now focused on this. Whatever the case may be, there are a bunch of companies that were added from the non-ESG uh, funds to the ESG funds, but their track record didn't get any better after they were added, which is also surprising. You'd think that if I'm running a corporation and one of my biggest investors is this fund manager, let's call it Vanguard or BlackRock or whomever, it doesn't matter, and then that manager removes the company from their non-ESG portfolio and adds it to an ESG portfolio, you'd think that number one, there's probably a reason for that. Either the corporation has communicated that they're going to change their practices, or they have some new outlook, or I don't know, corporate ideology or something. And you'd think that it would get better, either because the investor wants it or because the corporation is communicating that outwardly, and that was flat not the case. So this is really telling and really interesting. You have greenwashing both at the fund level. So as investors, the stuff that we buy is being messed with for marketing purposes because there's so much interest in it. And secondarily, it's happening at the company level. Companies are claiming to operate in a more ESG focused way because there's so much investor interest. They want to attract dollars from individual investors and institutions and funds, just like the funds want to attract investment dollars from the end investor. And at the company level, this happens in a bunch of different ways. They can send press releases of, oh, we're going to do things differently. Here's a good example of this. You see a TV commercial for like ExxonMobil or Shell or something like that, and they have basically the whole commercial is them touting their initiatives to save butterflies and stuff like that. That's exactly what we're talking about. They're still fossil fuel companies, and yeah, maybe they have a PR campaign and throw a few dollars at some green energy initiative, but where nearly all that money is still coming from. Here's another example, a corporate example I came across. H&M, the clothing manufacturer, came out with some new line of clothing called the Conscious Collection. And they're claiming to come out with this product that's supposed to be more, socially and environmentally aware and sustainable than most of their clothes. Well, they're getting sued in federal court right now because in reality, the company actually uses way more water and way more resources to produce the Conscious Collection than it does their ordinary clothing. It's a pure marketing ploy, and it'll be interesting to see how the lawsuit goes. To me, it seems like fraud. So this because there's so much interest in general in this, because fund managers and corporations are trying to bring in dollars to their own operations, there's greenwashing. They claim to be doing ESG stuff and they're not actually doing that stuff. And on top of that, the companies in ESG funds actually have a worse record than those in non-ESG funds, it's almost comical. So this brings us to the second issue going on, and that's nepotism, right? So this is obviously a political issue. You're traditional ESG stuff, when I say environmental, social, and governance, you think of environmentally friendly. Generally, those are companies that have less of a carbon footprint. They're not engaged in coal mining or fossil fuel production. They're conscious of, excuse me, water and other resource usage, that kind of stuff. Social, they may take a stand on social issues or have, I don't know, one example might be having like a generous paid family leave benefit for employees or something like that. Or think of any social issue that's somewhat divisive. They take a stand on that and manage their operations and their corporate philosophy around that issue. And then the third is governance. And when we say governance, what I mean is basically checks and balances within a corporation, right? A lot of people think that the CEO of a corporation has ultimate power, and they do wield a heck of a lot of power. They have all the employees reporting up to them in the org chart. But remember that there's also a board of directors that's elected by the investors. And in closely held corporations, like the founder of the company might also be the president and CEO and have the most votes and the most shares and all that. Well, they can name whatever board they want and do whatever they want. But in most large publicly traded corporations, the CEO does not have that quite that much power. There's a board that's elected by a wide group of investors, and the CEO reports to the board, and the board is the one that decides on CEO compensation package, and they decide when the CEO gets fired and replaced, and all of the above. So a good governance structure is one where that system of checks and balances is in place, and there's a strong framework for the benefit of the shareholder like you and me who might wind up buying the stock. If that's in place, that's typically good. If it's not, that's typically bad. So, from a governance standpoint, this is less political, less divisive. But from a social and an environmental standpoint, it's very divisive because go down the line of any social issue. Um, I don't know, guns, abortion, all the stuff that's um, making a lot of headlines right now. And a lot of people feel strongly in one direction, and a lot of other people feel strongly in the other direction. Yet what's happening is the managers of big pools of investments are wielding power over what direction the portfolio takes. So this is why this has been in the news. This is why the Florida pension fund pulling money from BlackRock is interesting. It's because if you think that, so on the one hand, there are a lot of entrepreneurs out there who want to operate their company in a way that, again, aligns with their um, personal values and personal ideologies. And from my perspective, that's great. It's, entrepreneurship is a tremendous way to imprint your view of the world on the world itself, and that's wonderful. But once you have other investors, you need to consider their interests too, and it becomes I get more of a sour taste in my mouth when I see CEOs and executives of large corporations with a diverse investor base start to operate their corporations in that manner, right? So if you have somebody with a big company and they own 100% of the company, they can do whatever the hell they want. It's their company, that's fine. But if you have, 10% of the stock, but you happen to be the chief executive, and the other 90% is owned by thousands and thousands of index fund investors across the world, well, that's another thing. And taking a stand on social issues when you're in that position of power does not always reflect the interests of your investor base. So that's precisely why Florida and Governor DeSantis pulled their pension funds from BlackRock. They felt like BlackRock was operating in a way that they were not comfortable with. I think the quote was ideological differences. They were upset BlackRock was being too woke. DeSantis, being a Republican, didn't like that very much, and so they're pulling their funds. And say what you will, regardless of what side of the aisle you're on this. I think DeSantis probably made a wise move. If you have an organization that is clearly taking a stand, I can't cite exactly what BlackRock was doing to make them feel this way. Maybe this is just political noise to support his run for president. Yes, you can make that argument, but clearly he felt like BlackRock was doing things that did not align with Florida's constituents and the governorship in Florida. So he's pulling it. And from my perspective, if you're responsible for an organization and you're responsible for a lot of investment dollars, you have to either play it neutral or play it in a way that's clearly disclosed and transparent and reflects the interests of the shareholder base. Okay, so it's one thing to create a mutual fund that says, I'm going to invest only in gambling companies, or another that says, I'm going to invest in everything but gambling companies, right? Both of those things are totally fine. The issue is that you have to be completely transparent about it and disclose exactly what they're doing. You can't just open a new investment fund and slap the word ESG on it and go invest in the exact same stuff. You actually have to do what you're saying you're going to do in the prospectus. So DeSantis didn't like this. They're pulling all their money from BlackRock and going in another direction. Interestingly, Florida is not the first state that's done this. Louisiana and Missouri have recently pulled their pension funds from BlackRock as well. So it's this interesting juncture that we're at right now. You have, on one hand, corporations are often kind of leaning into this woke ideology, and that can be kind of a problem, especially if you're the biggest investment manager in the world and have stakeholders through your investors, through investors in your funds, through your employees that may not be totally aligned with that. So greenwashing is a huge issue in this space. Nepotism is an issue, and for other corporations and other organizations, again, from my perspective, I think it's totally fine. Do whatever you want with your own company, but uh, you just have to remember how important transparency is with all this. And if you have a base of investors in a company that are diverse in their own ideologies, then you better have a good governance mechanism to sort all that out. Because if you don't, you're gonna be at loggerheads. And if you have half of the investor base that feels strongly in one direction and the other half feels strongly in the other direction, then the corporation probably shouldn't take a stand, right? And play it neutral if there's dissent among the ownership of the company. Okay, so the third thing is performance. And this one ought to be obvious. For those of us who might consider this as an option, we have clients who are really interested in ESG strategies. What we want to know is it going to produce better investment returns or not? Right? Not only do you have the issue of selecting an investment that's actually going to do what it claims to, because you're worried about greenwashing, and maybe a manager or management of a company that runs a fund that you might invest in, wielding a lot of power, that could be another risk factor through potential nepotism. But you also have the question of, how is this thing going to perform? Is investing in a way that aligns with my own ideology going to produce better results or less good results? And how much do I care about this? I do want to change the world for the good, and I want my investment dollars to reflect my own values. And this is a nice way to push the world in that direction by investing my savings in a way that's aligned with that. But if it's going to produce crummy returns, I might not care about it that much. So that's a question that we have to answer as well. ESG investing hasn't been around for a terribly long time. I think the first ESG funds probably came out maybe 15 years ago, I want to say, and it's really taken off since then. So if we took a data set of all the ESG funds that have existed since the very first one, we don't have a terribly large data set that would give me a whole lot of confidence in the result. As far as timeline, really, we need at least a couple decades to determine whether this kind of strategy is, or let me put it this way, we need at least a couple decades to have a reasonable amount of confidence in the outcome. And even then, you think of 2 decades, 20 years, you've only been through a couple business cycles in that time. Even then, you don't have that much evidence to use at your disposal. That being said, here's another study I looked up. The University of Chicago looked at this last year. Researchers from the University of Chicago, they looked at Morningstar returns and ratings of over 20,000 mutual funds in the U.S. Okay, ESG and non ESG, and 20,000 mutual funds is about it's pretty close to the entire investable universe of of mutual funds here in the U.S. anyway. And then they took a look at Morningstar's ratings for sustainability and compared it to the performance. So if you rank all the 20,000 funds for sustainability, with the most sustainable funds at the top and the least sustainable funds at the bottom, none of the highest rated funds, and I forget what block they're looking at, but of the highest rated sustainable funds, not a single one outperformed the lowest rated funds at the bottom of the list. So from a performance standpoint, they have not done better, although they have brought in a lot more inflows, a lot more new dollars being invested in them because of the interest and the marketing angle and so forth. So we can't fully trust it. I don't have full trust in that little snippet that I just mentioned, nor would I have a whole lot of trust in a more thorough piece of research that really came down to numbers and standard deviation, and on average, how much better would an ESG or non ESG fund do compared to the alternative. I wouldn't have confidence in that because the data set is simply not that big yet. But to date, all we know is that it hasn't really done that well yet. And if you're someone who has the resources to sacrifice a little bit of your return long term for the sake of aligning your investments with your values, and that's one thing. Maybe you can still continue down that path to justify it. But for most people out there who really need to squeeze as much return, or want to squeeze as much return out of their investments as they possibly can, because of all these issues, because of the potential nepotism issues that need to get worked out a little bit, and certainly greenwashing is an issue that, and yes, again, the SEC is starting to look at this. This will get cleaned up. It's just a matter of time. For people that feel strongly about it, I think it can be a good fit. I think you can select investments that do a good, consistent job of choosing underlying, companies that check the boxes for you. It's all just in its infancy. There are a lot of wrinkles to iron out, and it's going to be kind of a bumpy road. I would guess that people who own ESG funds right now, if you really looked under the hood at any of the stuff that you own, there's probably going to be stuff in there that you don't agree with, just because that's the state of the industry. Yes, on the whole, your portfolio will be weighted toward the good stuff and away from the bad stuff, whatever that means to you. But it may sacrifice return too. So that's it for today. I hope I didn't jump around too much, but this has been gaining a lot of momentum. This idea, it's been in the news a lot. We get a lot of questions about it. It can be a good thing, and it absolutely will improve. And the other thing that will become more accessible for people are ways to do this on a custom basis. So if you are a religious person and don't believe in abortion, but you really believe in sustainability and don't want any fossil fuels, in the not too distant future, you're going to be able to build a portfolio pretty easily that aligns with those intentions, even if there's not a specific mutual fund out there that you could buy to do that for you. So investing is accelerating, and there is a fair amount of innovation in that space to be able to do those kinds of things. And we're not that far off from being able to do it in a really customized way. All right, that's it for today. If you haven't done so already, if you haven't done so recently, please head over to Apple's podcast page and give us a 5-star review. It's been a while since I've asked for that. We are gaining a lot of downloads. The podcast is growing. I'm really happy about that. And we're now about 3 years into publishing it or producing it, I should say. So I've learned a lot. I think the episodes do continue to get better, and the listenership is certainly growing. Okay, thanks for hanging with me. Hope you have a good week, and I'll talk to you soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.